On behalf of Resurgent India Limited and on my behalf, I would like to welcome all of you for joining us in this today's webinar, which is a very, very important topic called distressed assets and funding opportunities in India. I think this topic is very relevant in the current scenario. Even after COVID, distressed assets are there actually, which are increasing. So we have a very good panel today. We have bankers, we have private equity fund, we have practitioners who are into the resolution profession and helping the funding side also. So friends, we would love to listen them in the today's discussion that how this research assets funding can be done. What are the different ways of funding and all. So I would like to thank you to all the panelists also for their confirmation and support. So we have Bharat Ahuja, who is the senior banker from State Bank of India and with faculty also. So welcome Bharat Ahuja in this webinar. Then we have Mr. Puneet Chadda. Puneet Chadda ji, the Director of Finance of Chris Capital. Puneet ji, welcome to you in this webinar. Then we have Sudarshan Kedia, who is the Vice President of Resurgent Resolution Professional LLP. Welcome, Sudarshan ji. So, friends, we just see this COVID has impacted on the corporate earnings in a big way, and in many ways also, and this has this is becoming difficult for them to get the more line of credit and how on the opportunities and scope of alternative financing as well. So one side is a difficulty, another side it is opportunity. At the same time, consideration needs to be given to the distressed assets for the revival through investment solutions, which are permitted to be made and returns are repatriated to investors, since structures used in more sophisticated markets cannot simply be replicated in a highly regulated market in Asia, such as India. So India is a very highly regulated market actually. That is good for all of us. Therefore, this conference will surely be defining the lines on which solutions for distressed assets can be proposed. The mission of this conference is to highlight the types of distressed assets and funding opportunities available in India, identify strategies and solutions to fast track project execution, discuss the key issues and potential solutions, and showcase the most noteworthy projects and promising technologies. The conference will also provide a platform to industry players, policymakers, investors, consultants, and technology providers to share their experience and exchange their ideas. Friends, the key points of discussion will be the general regulatory and tax regimes, whatever the regulation is there for the distressed assets resolution, and the funding regulations, and the different types of equity investment opportunities. Then we will discuss the risks, challenges, and the rewards. What kind of risk is involved? What kind of challenges are there? And what kind of rewards are there for the investors? And the different structure for onshore and offshore investment. So there are domestic funds, there are foreign funds. How they look at this market, and what are the tax impact on these funds? And then we will discuss the need of robust incentive framework. So what is the expectation from the regulators, from the government, so that there should be a robust framework where the resolution can be fast. So I have prepared a small PPT, which I would like to run through, which will help you to get more understanding about the entire space of this distressed assets and opportunity in distressed assets space. So friends, first it is very important to know that what is the distressed asset. So distressed assets is mainly the asset where there is a default by the issuer, and the banks are unable to get the principal and interest on that asset. So this assets becomes the distressed assets, and the companies can basically uh, file the resolution. They can do the restructuring. There are many ways of resolving these assets. So we will discuss in detail. And in India, if you see, the government has promoted, and the investors, there are many investors who have seen this opportunity because of the IVC, which has come in picture in 2016. So the investors are feeling protected to invest or to take the stake in the distressed assets, which is, I think, creating a lot of interest. And if you see, uh, because the investors are putting money because they are seeing the high value assets are coming at very low cost. So the major region of investment is basically they can take the advantage of this kind of value proposition. And if you see, the for buying out of any distressed assets or for investing in any distressed asset or any asset, there is a need of lot of planning, lot of I think understanding has to be done. Lot of due diligence, lot of other aspects should be seen, because it's a high risk investment also. So we will discuss in detail about this next. So who all are the investors in the distressed assets or these kind of assets? So the corporates are taking the lead. Many corporates, large corporates, are investing in these kind of assets, and because of high risk and the large amounts are involved, so it is very difficult for the small businesses to afford this kind of investment. And then there is other way of the other type of investors. Those are the alternative investment fund. So SEBI has now regulated that the alternative investment funds can also be set up for distressed assets investment, where any investor can put minimum 1 crore of rupees in this fund, and in turn, these funds can invest any sum in the distressed assets. But the condition is that in a single fund, there should not be more than 1,000 investors. Next. So why, how these distressed assets work actually, if you see, why the investors are showing interest and all, because you see that the trend is, which we have seen, that there is a discount which is something around 20 to 80% on that asset. So this is I think the advantage for investment. And there is another aspect also, that there can be a loss also to the investor. The company goes bankrupt, and they cannot turn around that business or that asset. That is the I think challenge. And there is one more aspect, that investors are getting the preference at the time of payback. So this is an advantage. There can be another type of investors, or the takers. The creditors can also take the ownership of the company. I think it has happened in very few cases, or maybe there may not be any case. But this is another area also, or the other type of investor who can, the creditors can take the control of the company, and they can turn around also if situation or the regulator allows them. Next. So friends, before investing in any distressed asset by any investor, many things have to be seen. So the first and foremost thing is the risk. So any investment in the any distressed assets, the risk has to be evaluated. That what kind of risk is involved in the in case of worst situation. So that is very, very important. There are a huge risk is involved. The reward, definitely when the risk is there, then the reward will also be there. So the investor have to evaluate that what kind of the valuation or what kind of value they can derive out of this asset. So what kind of discount should be there and all on that asset. Next. Then they need to consult with the experts. So it is not necessary that any investor or any fund or any corporate is putting money. Yeah, they are having that kind of expertization. So they can take the help of the different experts, the technocrats and the other experts who understand that business before investment in any of the asset. Due diligence is must, because before taking any exposure in any of the distressed assets, there should be the due diligence, the legal due diligence, financial due diligence. So lawyers should be involved, chartered accountants, the financial firm should be involved. Though they can do the proper due diligence so that there should not be any surprise later on. And there should be a proper incentive framework also whenever any business asset has been takeover or investment has been done. So all the stakeholders should have the robust incentive framework so that it should be win-win for everybody. Next. So India is, I think, coming up. I already done a lot of things. So this IBC is now it's more than 5 years in India, and a lot of examples are there which the IBC has created. So I can say that now it is maturing, and this one provision, which is a very good provision, where this the investors or the government has basically barred the promoters to buy their own property or own assets, own business, this IVC framework. So this is another aspect. Then you see there is a need of long-term funding for any kind of distressed assets. So any investor who has long-term funding, deep pockets, and their understanding of the regulation, they should invest in these assets. And there is an opportunity that India currently is having the, I think, worst bad loan ratio among the major economies. Even it was worst before the lockdown also. And there is an expectation that this number will also increase. So I think this need to be seen. Next. So regulatory framework is very conducive, positive for the resolution of the distressed assets. So it's a time-bound framework for resolution of any asset. As per the regulation, I think there are number of days. So I think 270 days are the maximum for resolution of any distressed assets. And government and the judiciary is very prompt, proactive for resolving the issues and to make it more effective. As I told you that the promoters or the sponsors are barred from acquiring their own companies during the resolution process. Government has come out with that pre-pack insolvency resolution process for the micro and small enterprises, which is helping to MSMEs. We have a large number of MSMEs. This bad bank has been created. This was announced in the budget 2021. So now this bad bank has already been created. Then the robust this trading platform for the default debt securities also, the government, I think, regulator has also announced that they should be they are permitted for trading in the defaulted debt securities. So this is good actually. If you see the government, the regulators are taking it very positively, that how the resolution can be fast, and the investors should get the confidence to drive the confidence out of that. Next. So there are many investors. So I think Rohan, can you go on the last earlier slide? So there are global funds, domestic funds. Those are looking a big opportunity in India, and they have already pumped a lot of money. I think a few $1 billion have already been pumped in the distressed assets in India. I believe more than $4 billion have been already been invested in this market. And these funds like Apollo, Global, Oaktree, SSG, Kotak, Ares, Edelweiss, Bean Capital, there are many funds who are looking to take the exposure to invest in these assets. So anybody who is looking to get funding for the distressed assets, they can approach these funds. They have a lot of money to invest. So in last, I think the last slide. So one, you can come on the last slide. So in conclusion, this I think this is a opportunity because of the lot of assets are available, and the investors are also seeing it in a positive manner, and this market is getting created. And I think this pandemic has also created, I think, some kind of situation where the more and more assets are getting into trouble. So there is a need of faster resolution of these assets, and there should be the opportunities or options for the investors, and there should be a the framework where the investors should feel confident to take exposure, and whenever they want to exit, there should be a smooth exit for them also. So, friends, we have a panel. As I told you that we have Bharat Ahuja ji, who is the very senior person from SBI. So first of all, I would like to thank you to SBI for joining with us also at the partner, organizing partner for this webinar. And Bharat Ahuja ji, the AGM and faculty of SBI CRM, he has more than 30 years of experience. And I think almost 24 years of experience he has in the corporate and MSME. And he had worked in the different departments also, the syndication, private equity, and the triple P projects also. So, Bharat sir, first of all, thank you very much for joining with us and giving us time for this webinar. So, sir, you are representing a large bank of the country, which is having very large portfolio. So we would like to understand from you that as SBI, how do you see this the entire distressed asset situation in the country, and then how the IBC is also helping, and how the SBI, the bank, is resolving these assets and taking exposure in these assets whenever the opportunities coming. So over to you, and thank you very much. We would like to listen from you that the SBI perspective for the distressed assets in the Indian market and the funding solutions for that. Over to you, sir.
Thank you, Ashish, and thank you, Resident India, also for giving me this opportunity to interact. And I welcome all the panelists also who are actually present in the webinar. I don't have any presentation, but I'll just have a sort of a discussion or sort of an interaction with all of you on the basis of the topic that has been sought today to be evaluated on various aspects with regard to the distressed assets. So as far as distressed assets are there, so yes, you are very right that after IBC and the last 4 or 5 years, it has been a game changer in many ways, because we were traditionally relying on the DRTs, SARFAESI, and to an extent to the ARCs also, to whom we are actually selling the distressed assets. Not only the NPAs, but otherwise also the distressed assets were there. And basically because it can be converted into some security receipts. So India is not a market where the trading has been developed to such an extent in the case of security receipts. But yes, there is a way out for trading, and otherwise in the absence of the listing of these security receipts, there is an option of e-auction of these security receipts also. So coming to the IBC part, and let's see what is the latest developments with regard to the distress and with regard to the budget. So the budget has come out with two things. One is the insolvency part in case of foreign assets. So cross-border insolvency. where it will be possible for the Indian lenders to go in for the insolvency proceedings against the borrowers who are holding their assets in some foreign countries. Vis-a-vis, again, if any insolvency proceedings are being started in some foreign country and the borrowers have some assets in India, they can also be proceeded against. They can be actually directed towards the insolvency proceedings again. So that is what is about the cross insolvency is all about. In case of Jet Airways, you would have you must have seen that indirectly, yes, the cross-border insolvency was allowed because the insolvency proceeding started in Netherlands as well as in India also. So when the Netherlands actually approached the NCLT, it was not allowed. But then when they appealed to NCLT, the NCLT allowed the proceedings. So simultaneously, the Netherlands as well as in India, it was allowed that. So in a way, we can say under some indirectly, the cross-border insolvency was allowed in that case also. The second aspect is with regard to the fillip being given for the introduction of bad bank. So the two companies, that is your NARCL and IDRCL. So NARCL will be the acquirer of the distressed assets, and this will have the major shareholding from the public sector banks also. And IDRCL, which will be for the managing of these distressed assets. So these two companies will be there, while IDRCL will have the majority stake of the private banks, and NARCL will be having the majority stakes of the public sector banks. So here, with the formation of this bad bank, I believe that much of the portfolio, so in the initial tranche, about 50,000 crores will be transferred in 15 accounts from various banks to the bad bank. And ultimately, because there is if there is a shortfall in the realization of these assets, so there is a government guarantee of 30,000 crores, also 30,000, I think 30,600 crores also. Because overall, it is expected that around 2 lakh crore of bad assets will be transferred to the bad bank in this case. So these are the two things in case of with regard to the distressed assets and the fillip being given by the government for further investments in distressed assets. Because again, the bad bank will be having 15% cash upfront by way of acquiring these assets, and 85% will be through the security receipts. So the government guarantee is there also to meet any shortfall in the realization of these assets. And because it is likely that there will be a pool of assets, so obviously the likelihood is that there will be a lot of realization among these assets. Going forward, I can share with you some of the data with regard to the new investment announcements sector-wise, if you can see. So I have seen that basic chemicals will get more than 1,66,000 of crores of investment, and iron and steel is going to get more than 1,07,000 crores of investment. Community services, again, 1,16,000 crores, and roadways, 1,79,000 crores of investment from the government. Real estate, again, 1,19,000 crores of investment. So these are some of the sectors where more than 1 lakh crores of investments will be made by the government in these sectors. And then going to the government investments and monetization plans for the next 3 years, and the debt requirement from 22 to 25, I would say. Then national infrastructure pipeline funds, 70% would be, and 30% would be the debt. And the sectors are basically energy, roads, railways, and urban infrastructure. These are the major sectors. Then under national monetization pipeline plan, around focus sectors are roads, railways, power generation, transmission, gas and petroleum pipeline, etc. And under PLI scheme, performance linked incentive schemes, major sectors are like your mobile and specified electronic items, automobiles and auto components, ACC batteries, and semiconductors, and high efficiency solar PV modules, etc. So these are some of the focus areas by the government. And another data which I can actually share with you is with regard to the ratings, rating wise upgrades and downgrades in various sectors. So there are around majorly 23 sectors. And in cement sector particularly, there has been a major upside, like the overall ratio from the number of companies which have been downgraded rating wise, and the number of companies which have upgraded. So there has been an entire shift from being 0.55. That means earlier, this is the 9-month comparison between financial year 21 and financial year 22. So during the first 9 months of 21 and the 9 months of financial year 22, if you see the rating wise, the cement sector, there were 12 upgrades and 22 downgrades. As against this, during financial year 22, first 9 months, 27 companies have upgraded and 14 have downgraded. So the overall percentage from 0.55, it has come up to 1.38. That is something with regard to cement. But otherwise, in almost majority of the sectors, improvement has been reflected. Like if I can say, in case of your healthcare, so it has jumped from 0.32 to 0.46. In case of consumer durables and apparel, 0.08, it has come up to 0.15. Then in case of steel, also 0.18, it has come to 0.31. In case of IT, it has come from 0.13 to 0.25. So likewise, many of the sectors, in fact, tires and rubber, in fact, there were only downgrades in 30 companies. In that sector also, there have been 10 upgrades and 22 downgrades. So whereas it was 0, it is now come up to 0.45. So that is something, some positives with regard to the recent, coming out of the COVID and the third wave and all these things are there. So that is one thing. As far as distressed assets are concerned, so traditionally we have been looking at various scenarios like going in for recovery. So we had the SARFAESI Act. It is still one of the major tools with the banks to go ahead for recoveries wherever it is not possible to have a going concern recoveries. So IBC has provided that thing, and one thing that IBC has done is that as far as I'm not saying the taxation angle from the individual investors who are investing in the funds, but I am looking at the tax benefits to the promoters who are investing in these companies. So if you can see under normal M&A activity and as well as in IBC also, where it is a going concern and the new promoters are going to invest in a company, so they can carry forward the losses. So to the extent of carry forward of the losses, they can get the taxation benefits. Plus, suppose hypothetically, if the valuation is coming to 500 crores and ultimately the value is being settled at 100 crores, so the notional gap of 400 crores, that also again is not to be taxed as far as IBC is concerned. So from the investors' point of view, who are the promoters in these companies, so they are also getting some tax benefits to that extent. Of course, there can be some court cases are there with regard to filed by the income tax department, but I believe the code is very clear and with regard to these two things. So as far as SBI is concerned, we have been actually selling some of the asset to ARCs, and for the ARCs now there can be various. In addition to the ARCs, there can be some. It can be a scheduled commercial bank also. It can be your FIs also, NABARD, Exim Bank, SIDBI, or small finance banks. NBFCs can also be there, or asset reconstruction companies registered with the Reserve Bank of India under the SARFAESI Act, or any other company other than the financial service provider can also be there as far as selling of distressed assets is concerned. So that is in brief the way how we are dealing with the distressed assets. As far as any distress in the asset is concerned, so if it is at a very initial stage and we have to do about rehabilitation or restructuring part, then I believe that if it is a project funding, then we are having that benefit of DCCO guidelines are there, date of commencement of commercial operations are there. So there are certain benefits in case of infrastructure projects. So as the time limit can be extended as long as up to 6 years also in some cases, wherever there is a change in promoters also. Suppose if there are first 2 years are there and there's a delay in the project due to COVID reasons or due to some other reasons also beyond the control of the promoters, or there can be some court cases, some legal issues due to which there has been a delay, or if there is a change in the promoters, then the maximum time limit given in case of infrastructure project is up to 6 years. So that the asset can be retained in the standard asset category, but there can be a little bit higher provisions in those cases. But yes, the asset category is maintained, that is subject to certain guidelines. So in those cases, there can be some additional funding also, like some cost overruns within overall 10% limits, including any fluctuation in the foreign currency, etc. Also, those can be covered. And in case of IBC, we have we can give some interim finance, so that minimum optimum level of going on concern, that activities keeps on going on, so that it maintains the going on concern status to that extent. So yes, on a case to case basis, we can think of your interim finance also, which can be part of the, if it is the resolution is not successful, then it can be part of the liquidation cost also at the end. So with that, I believe that this is an overall view, the way we are actually handling the distressed assets and in the current scenario, what we are trying to do at best possible. In addition to that, yes, there's a PPRP is also there now, because of the MSMEs, which is applicable for they can have the pre-packed insolvency resolution processes. So first, we have to offer the MSME borrowers what they have to offer. Then, if we are not comfortable with their plan, then we are going into the normal CRP processes under the Swiss challenge method.
Okay. Great, sir. I think you have given a lot of insights. You have covered very well the regulation, the taxation aspects, valuation aspects also, which has given the lot of, I think, understanding to the attendees, where the kind of the government has given the advantage or kind of incentive. These are incentives actually. Practically, we see the valuation, the taxation is not there, and the losses can be carried forward. Then in case of infrastructure project, this commencement of the date can be now by I think given the additional time. So these are the major things which are helping the resolution process. So they are helping the investor also to come in and to invest to do the resolution of these assets. But sir, one more thing which, please.
Yeah. Just one thing I just wanted to incorporate here, that we need to work on the valuation aspects, particularly in the wake of IBC, for the sake of going concern, because when the company is doing well, there is a different way of doing the valuation. But in case when the company is under distress, so there can be two valuation. One is the asset value, and the second is if it is to be held as a going concern, then what can be the valuation. So that is one area where we feel that I believe that there is some improvement is required. So that part needs to be a little bit improved.
Okay, very well, sir. So one thing which we would like to understand from you, sir, the SBI bank. So if you see that as per the normal guideline for domestic acquisition of any asset, I think the domestic acquisition of any business, the funding cannot be given. I think if you want to buy out the business outside, then I think this as per the RBI guidelines, the bank you can give the funding. So in case of this distressed assets resolution or distressed assets or distressed business buyout, can it be possible to get the funding from the bank by the new promoter for buying out the businesses through the resolution process or through the other areas?
I cannot rule out that possibility, but ultimately, see, we have to see what is the resolution plan coming from various applicants. So which applicant is giving us the best resolution plan? If any applicant, maybe not in the initial stage, but at a later stage also, some funding, etc., can be given, keeping in view the overall perspective of the project, I suppose. So it is not that there is any bar on that, but of course, the best resolution plan, because the bank would like to get that NPA status out of the zone when we are entering into the resolution plan. So it is not about the recovery. I'm not saying, suppose it is a 1,000 crore of plan is there, and my 1,000 crore is stuck up as NPA in that particular asset. So if a resolution plan is coming, it is not that I'm recovering 1,000 crores here. It is not about recovery. Suppose the resolution plan is there that they are paying upfront 100 crores only, and the remaining 900 crores, how the 900 crores is going to be converted into standard asset, that is something I have to see. So it is not about the funding part to that extent. I believe that the promoters don't want the funding to that extent. They may require some funding, but then they will be having their own bankers to support them also. Or maybe they have some other sources for funding that also. But here, one thing is that if 1,000 crores is involved, and what is the haircut that I'm getting? Suppose 500 crores is going in for the haircut. So I'll be interested in how quickly the remaining 500 crores is going to convert into a standard asset. That is the purpose. So it is not about getting the recovery there.
Okay.
So how best the resolution plan is being submitted, that is the idea. So if suppose
that's
someone
okay.
he wants to pay 50 crores upfront in out of 500 crores, and the remaining 450 they're proposing to pay in 7 years or 8 years already. So by that way, we are actually converting that NPA into a standard asset in our books.
Yeah, that is one way that you are converting into a standard asset, and if they need some kind of funding to acquire that asset, actually, that can also be given on case-to-case basis by the bank. That is, I think, you want to say.
Yeah, that is.
Okay. Yeah. Thank you, sir. Thank you very much for your deliberation. So we have Puneet Chadda ji. Puneet ji, the Director Finance of Chris Capital. Chris Capital is a well-known name in the private equity market. Puneet ji is there with this firm since last 2015. And he had worked in very many other large organizations, KPMG, Macquarie, then ValueQuest and all. And he has very good understanding and experience of working in the different domain of finance, private equity, taxations and all, and due diligence also. He's a chartered accountant by profession. So Puneet ji, first of all, welcome to you. And thank you very much for joining with us, being a private equity fund. We would like to understand that the how the Chris Capital is helping the corporates by putting money, private equity money, whenever you are investing, what kind of sectors you are looking for, what kind of ticket size you are looking for, and what are your expectations from the businesses or from the promoters when you are investing in any kind of business, in the corporates or in the any country. So over to you, and thank you very much, sir.
Sure. Thanks, Ashish, and thanks, Resurgent, for inviting us for this. And I think Dwaraji gave us a good overview of how the banks look at it. So maybe we will cover a few angles as to how an investor looks at it.
Correct.
Right. So see, any private equity or any investor isn't there to make money for its investors. There are investors behind the private equity investors as well. So see, investment in the distressed and stressed assets in India have come a long way in the last 5 years since the introduction of IBC, as you also touched base on. So banks and financial institutions are looking for selling the non-performing assets at an attractive discount to the investors to release capital. At the same time, I would say stressed companies are also looking to raise capital from the funds for the last mile funding for the projects or for settlement with the banks. The need of the hour here is the long-term patient capital to restructure or resolve the assets. So we believe that the investors and asset managers with deep understanding of local regulations and expertise in assets turnaround will stand to immensely gain from this opportunity. Now, like in every, I would say, for every private equity transaction, the way the factor that one should be considering for a transaction or for a deal are a little different as compared to what one should be a little more focused on in a distressed situation. Maybe I'll just touch base on a few of the important factors which one needs to be considered while looking into distressed assets. First one I would say is risk and reward. In general, the risk and reward, as you know, higher the risk, higher the reward. And in a situation like this, the risk is much higher. Having said that, given that a lot of these assets are pledged, the collateral is pledged, so that gives some flow to the returns as well. However, these investments are inherently riskier because of they are in the distressed situation. So there can be a valuation as well as liquidity issues, and the price discovery can be a challenge as well. So that's where I think the whole expertise of a fund or a private equity or an investor comes in to determine what is the right price they can pay to bring this asset into a green zone, I would say. Now, the distressed investments are usually standalone financial engineering opportunities with low, I would say, low correlation between the equity and debt markets which you see. You cannot compare it to how an equity market or a debt market is behaving. This is a very unique situation, and one needs to understand it on a standalone basis, asset by asset. You can't even put a general understanding on the distressed assets, so to say. But these can be a great diversification strategy for the investors as well. Now, one of the important factors which comes into distressed classes is the legal challenges. courts in India have historically been very accommodating towards promoter-led appeals. Adjudication timelines have been extremely long. However, IBC, I think, has done a great job in bringing some of these gaps. But still, I think there's a lot of improvement that can happen here to further facilitate, I would say, every stakeholder's interest, be it the creditors or be it the incoming investors or be it the promoters. So one of the key aspects which also one needs to consider is, I think Ashish, you also touched base on this, which is basically partnering with the experts. Now, considering the large amount of effort involved in scouting for and turning around distressed companies, partnering with an industry expert or a professional or a private equity fund or a special situations expert is recommended. So experts and their extensive networks help in sourcing opportunities, conducting reference checks, avoiding legal and valuation traps. Also, experts can help identify potential value assets even before they are officially classified as distressed. So working with an expert is very critical here. So even the expert fund or a private equity fund or any distressed fund that would come in, they will also, for a deal-to-deal basis, hire special experts who are experts in that particular industry, in that organization. And that expert can help them in the whole journey of changing that organization as well. Now, promoters are another key aspect of a distressed asset, I would say, and how the relationship with the promoter is, and are you aligned with the promoter as to, from the vision perspective, what they're trying to do, what they want to do over the next, how do they see the business in next 3 years, 5 years, are some of the very important things to be considered. Now, experts feel that it is difficult to run a company in India without support of the promoters, as they are usually a part of the management. Now, tiding over regulatory and labor unions, government and legal issues can become tenuous without the promoter support. Now, this is a little different from how you would see in the other parts of the world, where a lot of professional managements run the operations. But in India, a lot of companies are promoter driven and promoter run. So that nuance has to be considered and looked into in depth while doing any of these investments. Then I think the last, one of the important factors I would bring in here is an incentive framework. Right? Investor must set up a robust and fair incentive structure for each stakeholder in the turnaround story. So equity earnouts for promoters have worked well in the past, according to the experts. As I mentioned earlier, right, misalignment of the stakeholder interests can derail the restructuring initiative. So everyone has to be aligned. Everyone has to be aligned as to what are we trying to do in next 3 to 5 years, how the exit will work out, and how the exit will work out for the promoters or for the investors coming in. And that is how the journey will need to be planned, and so that to make it fruitful for everybody, who is in that journey with you. So I think these are the key things, I think, from an investor's perspective, one need to look at. Yeah.
Very well covered, sir. I think your views are very, very important because the people who are listening you, they are looking towards the private equity funds, how they see the opportunities and what kind of risk, what kind of reward, what kind of challenges they are seeing. So I think you're very well covered from the valuation point of view, taxation point of view, and the investment point of view also. By the investor, how do you see these investments, and what should be the precaution whenever any such kind of investment is there? If you can give us some, I think, brief overview about the risk capital. Many people are not very much aware. So that will be great also, how you are helping the businesses, and what kind of businesses you have helped in the past, and what are you looking for whenever you are investing the various businesses also. So over to you, and thank you.
Sure. So Chris Capital is the first homegrown private equity fund. We are in the business for more than 20 years, and we do both majority types of transactions. We have raised more than $4 billion over these last 20 years, and so we are a private equity fund. We don't do a lot of distressed, I would say, but yes, our overall investment strategy and style is to work with the promoters and help them through the journey of the growth journey, basically, with the company, and that's our main objective in getting into any investment.
Okay. Okay. Generally, we go for which sectors? Because we have seen many times the investors are having the mandate for investing in certain sectors also. So from the Chris
Yeah,
Capital point of view.
Chris Capital is in pharma, financial services, business and IT services, and consumer goods, and some of new economy as well.
Okay, so multiple sectors you are covering. So, so anybody who's looking for fresh capital and they want to grow further, they can look at to reach you and get the equity funding if it fits in your criteria or in your philosophy. So great, sir. Thank you very much. Thank you for your nice deliberation. And you're very well covered from the investor's point of view, because whenever we are talking any funding, the debt and equity both should be discussed actually. It is very, very important to know from both the sides what are the views of the different kind of stakeholders. So thank you very much. So now, friends, we have Sudarshan Kediaji, who is the Vice President of Resurgent Resolution Professional LLP. Mr. Kedia is having very good experience of working in the different areas in the corporate finance, debt restructuring, and the corporate banking, and currently is involved into this all kind of distress funding, distress resolution. So nobody can be better than him, who has seen from the ground and from the practical aspect point of view, and he has helped many organizations also. So Sudarshanji, thank you very much for joining with us and giving us this time for this webinar. We would like to understand from you, although this Bharatji has covered from the banking point of view, how the banks are seeing and all. So we would like to understand that what are the different ways of resolving the stress assets actually, and how it can be resolved. So I think our audience is very much keen to listen to you and to want to understand that how they can do the resolution of their assets, and what are the different funding options so that they can get funding on the distressed assets also. So over to you, and thank you very much.
Thank you, Ashish ji, for providing me an opportunity. Am I audible?
Yeah.
So when we talk about distress assets, so distress asset is something wherein the account has been classified either as an NPA, non-performing asset, or it's into an SMA category. So SMA category, when we talk about, there is a default, and default SMA default ranging from 0 to 89 days. So whensoever the account has been slipped into an SMA, either into an SMA or an NPA, then there need to be a proper resolution. So that proper means, when I'm talking about proper, means a permanent resolution. It's not a temporary or interim resolution which I'm talking about. So that can be done. There are various methods by which it can be done. So first of all, RBI has already come up with different circulars wherein the account can get restructured and a permanent solution aligned with the future cash flow can be given to the company. So there is a circular called June 2019 circular, which is being issued by the RBI. And under that circular, bank can restructure the existing debt of the company, wherein it need to be aligned with the cash flow, future cash flow of the company. And in case in that circular, the total existing debt can be bifurcated into sustainable debt as well as non-sustainable debt. So when we talk about sustainable debt, sustain means the debt which can be sustained as per the future cash flow. And when we talk about non-sustainable debt is something which need to be converted into an equity, which cannot be borne by the projected cash flow. So that is one of the circular which is very helpful. If there is genuinity in the hardship of the borrower, then lenders do take the request of the borrower and get it implemented. But this circular is being very process oriented, wherein forensic need to be done. Because why forensic need to be done? Because lenders need to ensure that it's a genuine case wherein the stress is something which is beyond the control of the company or the promoter. So forensic will ensure that whatever concessions or whatever relaxations or requests being given That is, they are giving to a genuine case only. Secondly, whatever cash flow whatever projected cash flow they prepare, the borrower prepare, that need to be vetted by an independent agency. That is, a techno-economic viability study need to be conducted. So that is also one of the very important area, as anything on an ad hoc basis cannot be acceptable to the lenders. So it need to be vetted by an independent agency who substantiate that whatever being drafted is technically and financially viable. Moreover, as per June 2019 circular, they have stipulated one more condition, that whatever resolution plan is being finalized by the lender and the TV consultant, that need to be rated by an external rating agency also. So an RP4 rating equivalent to investment grade rating need to be assigned to the resolution plan, and then only that resolution plan can be implemented by the lenders. So these are the 3 steps which are very important for the successful implementation of the resolution plan. Now there is one more circular which is very MSME centric, and an exposure to the extent of 50 crores at company level can take the privileges whatever is there. That circular has been issued in the month of May 2021. So that also talks about the restructuring of the existing debt. But in that circular, sustainable and non-sustainable option is not being provided. So whatever sustainable portion is, whatever existing debt is there, that need to be sustainable enough to get restructured as per the future cash flow. More, if the lenders deem fit that the future viability of the project or the company cash flow is not sufficient or is not viable, then based upon the forensic audit and the valuation of the securities, they can even do one-time settlement also. So one-time settlement is also an option, but therein provision already created by the bank plays a very important role. So bank do explore every avenue to recover their dues. If they fail to do so, then only they do one-time restructuring, or one-time restructuring proposal is lucrative enough to get more money than the security coverage, whatever they do have. Another option they do have is assignment of debt to ARC. Now, in case of assignment of debt to ARC, as we are aware of that, there is a liquidity issue with the ARCs, wherein they are also very selective to purchase any pool of assets or individual assets from the lenders on a cash basis. Because SR is one of the route which was previously followed, but now lenders are more inclined to do cash basis transactions only. So lenders prefer cash transactions, and ARC are very, very selective. So this is one of the route which is based upon the negotiation skill only. But the beauty of this transaction is that once the debt is being assigned to ARC, then there's a possibility that borrower can approach ARC and get their existing debt restructured also. So restructuring by ARC is possible, even if it is being assigned to ARC. Another opportunity which we do have, there are different fund houses and NBFCs in the Indian market who, based upon the security coverage as well as cash flow coverage, do prefer to fund distressed companies, irrespective of the fact whether the company's account is into a SMA category or NPA category. But their due diligence process, in spite whether it's an in-house or they get it outside, it's a time-consuming process. So the companies which do have good governance, corporate governance, that company can only sail through the due diligence and can avail the facilities from them. Because NBFCs or fund houses do relate that their fund, majority of their fund is private and not public. So they prefer to have more control over the promoters. Another option which is available is under IBC. When I'm talking about IBC, there are two opportunities for lenders to drag the companies into IBC. One is under pre-pack and another is under CIRP. So pre-pack is something wherein promoters' control is not being diluted and promoter stays in the company and resolution is there with the consent of the lenders. And it is applicable for MSME companies only. Wherein in CIRP, promoters with due respect has been thrown out from the seat and RP or insolvency professional take charge over the company for the proper resolution of the company. In some cases or in majority of the cases, it has been seen that resolution, there was no resolution under CIP, which ultimately goes into liquidation. But when we talk about liquidation, it doesn't mean that piecemeal or single assets are being sold. There is a provision under liquidation also that that company can be sold as an ongoing basis also. So that need to be explored, and further, if that is not possible, then piecemeal sale of assets need to be explored accordingly. Now, there are some sectors which are being very much impacted due to COVID. So I would like to name them. Firstly, there is a hospitality sector, which is being very much impacted by the COVID since March 2020, or we can say December 2019, by when China got impacted. Another is tours and travels. Another is trading activities. Another sector is hospitals. Now, I would like to clarify, we should not mix up with hospital with healthcare. Hospital is something wherein pre-planned surgeries are being postponed, which seems to be a major source of revenue for them. And due to that, there was a stress in hospital sectors also. And another sector is gems and jewelry. When I'm talking about gems and jewelry, it's a retailer, not a wholesaler. So in retail business of gems and jewelry also, as gems and jewelry seems to a luxurious product. So people during COVID times prefer to hold cash rather than being invested in gems and jewelry. And more so where weddings were also being postponed. So these are some of the sectors which are being impacted. Now I would like to bifurcate the funds who look very aggressive in funding distressed assets. So one is Indian origin distressed firms, and another is foreign origin distressed firms having place of business in India. So there is a different mindset for these two category of firms. So first I'm talking about Indian origin distressed firms. Indian origin distressed firms are being very aggressive in the market as they understand the Indian debt market dynamics. Secondly, they do have limited liquidity and they are being very selective in their distress proposals. Thirdly, they don't have deep pockets, and any big ticket size or large ticket size proposals, they prefer to do over co-lending only. They cannot write a single check for any big transactions. When I'm talking big transactions, any transactions more than 1,000 crores. Moreover, their IRR expectation is very high, which ranges from 18 to 25%. And they being very much tangible asset centric. So more security, they prefer more security for any transactions, although they do look into cash flow coverage also. As they are into they don't have any deep pockets, they prefer to invest in individual transactions rather than in pool of assets, which they can buy from the ARCs. Now I'm talking about foreign origin distressed firms having place of business in India. Now these firms lay emphasis upon corporate governance, transparency and integrity of the promoter and the company as a whole. So this is one of the benchmark which plays a very important role. Until unless this is not there, they cannot touch the proposal. Secondly, they do have lesser penetration upon the Indian market, so they understand less dynamics and emphasizes more upon the professional team of the company as well as corporate governance. They try to avoid regulated or commoditized sectors like sugar, textile, iron, steel. They are not very tangible asset coverage centric, and they prefer to understand the business model of the company along with the cash flow coverage, because that's, as per them, that is the integral part of the survival of the company. Their IRR expectation is not very high, and they prefer any IRR between 8 to 15%. They generally, as they do have deep pockets, they generally prefer to work with ARCs for pool of assets rather than taking a call upon any individual assets, although they are open to do so if their minimum ticket size permits. So they don't try to invest in lower ticket size because as per them, that is not worthy to look at. So that is Ashish ji, I would like to share. If you do have any query, you can let me understand.
Thank you, Sudarshan ji. I think you have very well covered in a very sequential manner. Also, you have given all the aspects of different process in IBC, then the funding, different kind of investors, also their expectation, also their return expectation and everything. So very well covered. I think our audience must have got the advantage of it, and they will definitely use it whenever they will look for any resolution of their businesses or the assets. It will help them also.
Sorry,
yeah,
sorry
sir.
but just to add what Mr. Sudarshan ji has said, just one point, that everything that he has said is quite relevant. The only one thing that as far as the June 2019 guidelines of RBI is concerned with regard to the resolution framework of stressed assets. So these guidelines are basically not applicable to the DCCO guidelines wherever these are applicable, the date of commencement of commercial operations with regard to the project funding. So these are not covered under these guidelines, and also those MSMEs small with small exposure like up to 25 crores. So there are separate guidelines by RBI in the year 2016. So those 2016 guidelines will be applicable for smaller loans covering MSMEs up to 25 crores. Because under those guidelines, there has to be a separate committee in which independent members are to be called, not from the bank, but from outside. There can be some retired bankers from other banks or any MSME expert as a committee member to resolve the issue. And there are certain timelines also. So that is something that I just wanted to add here with regard to the June 2019 guidelines, as far as those guidelines are concerned.
Okay.
That's all.
Thank you, sir. Thank you for adding your views on that also, sir. I think it's a great, good clarification also. So, friend, now the time is there for taking some questions. So we have a question from Mr. Chalapati Rao. So he has asked that what will be the role of bad banks and how they will dispose NPA assets in ways of different from what is done by ARC. So I think, Bharasat, this question is for you, that how different is the resolution by the bad bank in comparison to ARC. So it's the
So
same thing, or they say different thing?
basically, the bad bank is being formed to take care of the larger assets, basically. If you look at the first tranche, 15 accounts covering 50,000 crores. So that is a huge amount. Whereas in case of ARCs, we are looking at smaller loans also, 10 crores, 20 crores, 30 crores also. So despite having ARCs, SURFACE and all these things, there are still a large number of NPAs in the books of the banks. So this bad bank is basically, so when these large accounts are in the normal streamline, so it is an hindrance to the new business which the banks have to look for. So by transferring these assets to a bad bank, we will be focusing more on the new business. The service, while this larger exposures which have turned bad will be taken care of by the bad bank. So how this will be successful, only time will tell. But that is the basic purpose. And in addition to that, there is a government guarantee also, because the government is also interested in resolving these bad banks. So they are giving the guarantee of 31,000 crores in that to meet the shortfall.
Okay, so this is the additional thing in comparison to ARC, that the larger assets are giving to the bad bank, and then the government guarantee is also
And
there.
one
So
more thing
this
is there, bad bank comprises of not only the acquirer, but also the resolution part. So the professional, there are two companies, NARCL and IDRCL. So the two companies will be under the bad bank. So one, the company will be acquiring the bad assets, and the second, the company will be resolving the issues for taking them to the IBCs for anything, for any other thing which is not possible under ARC. Maybe.
Okay, okay, great, sir. Thank you very much. So there's one more question for Sudarshanji: how to recover and continue business in same name after OTS is paid? So Sudarshanji, can you cover this question? Somebody is asked.
I don't see any hardship. I don't see any hardship in continuation of the business even after the OTS being done. The only problem is that no fresh funding can be explored if OTS is being done, because civil do reflect settled account. So for the span of 3 to 4 years, no fresh funding can be done from banking channel. But if the business has good potential and the promoter has good quality of security, then additional funding from NBFC can be explored who are dealing with distressed assets.
Okay. So, sir, there is one more question for Puniji. Puniji, I think there is a lot of interest from the audience. So they just want to ask that in case of any kind of funding, when you are doing a private equity fund, generally how much time it takes and what is the process you follow? Because the bank is having different process, funds are having different process. So people would like to understand if you can explain about it.
Time overall varies from transaction to transaction. I would say on an average, maybe 3 months. I'm leaving all the regulatory aspects aside, just the due diligence and negotiation. I would assume at least 3 months.
Why is it taking, sir? Hello, sir. I think there is some connectivity issue there at your end. I think, are you getting my voice, all of you?
Yes.
I think Puneet, sir, I think there is some problems. No issue. I think he has clearly told that there are, I think, the different time for different kind of proposals depend on the stage of the readiness of the company or the promoter, and the process is that whenever any funding, private equity funding is to be taken, it takes due diligence and other processes. So I hope that he has already replied the answer. So friends, now we would like to, I think, close the session. We have already crossed our time limit. And I would like to summarize that I think everybody has covered very well all the aspects of our key points which we want to cover in this program or this webinar, where whether it's related to tax aspects, related to the IVC regulation and the funding options, and the private equity point of view, the banking point of view. So we have covered, I think, almost all the areas. Our speakers list have given good deliberation, or deliberated very well all the questions also of the audience. And I hope so that the audience, the people who have attended from different part of the country, they must have some kind of better understanding about the entire distress asset resolution by way of the different ways of funding, or the funding opportunities in India. And just to conclude it, I think I will say that there are a lot of distress assets. Definitely, there are a lot of distress assets out there. Banks are trying to resolve these assets. Government is trying to bring the favorable regulation. Judiciary is also helping the entire ecosystem, and the private equity funds are there. Then the professionals, like resolution professionals, are also helping. So entire ecosystem is trying to make it such a manner where the assets can be resolved, and it should be win-win for everybody. And I hope so that the distress assets which are there in the country will get resolved as soon as possible, and the banks will get the better, I think, I'll say, the contribution on that, because the funds have now shown interest. As I given in my PPT, that there are many large funds are there, those are billions of dollars. They are looking to invest in the distressed assets in India. Only thing is that, as Sudarshanji has told, that the corporate governance and all these things should be there. So these need to be taken care of. So I would like to once again thank you to all of you, for all the panelists, all the audience, and the Resurgent India team for organizing this program, bringing all of us at one place and discussion on this today's webinar. So thank you very much, and I would like to convey my thanks from the Resurgent India, and I wish that all of you should be safe, healthy in this current environment. Thank you very much. Thank you very much.
Thank you, sir. Thank you.
Thank you. Thank you, sir. Thank you.
Thank you very much.